Hello everybody, and welcome to the latest episode of Cannabis Unlocked. I'm very excited and honored this afternoon to be joined by Adi Divgi, the founder and CIO of Divino Global Holdings. Adi, how are you doing this afternoon?
I'm doing great, Jordan. How are you?
Doing great. Thanks so much for joining the podcast.
Thank you for having me. I appreciate it.
Absolutely. So, one of the initiatives we definitely wanted to take with Cannabis Unlocked this year is to interview more institutional investors who maybe haven't deployed capital into cannabis yet, but see the opportunity set there, just to really get your thoughts on how you're viewing that subsector in relation to the broader capital markets. But before we get into all of that, maybe it would be helpful if you give the audience a little bit of your personal and professional background.
Sure. Jordan, thank you again for the opportunity. A pleasure to be here. I have a 2 decade plus career in financial services. The last 15 years have been on the allocation side. The first 13 of those have been on the institutional allocation side. From 2011 to 14, I was at New York City pension funds, building out an opportunistic fixed income investment program from dollar one. The next 7 years, from 2014 to 21, I was at Catalina, a private reinsurance company, building out alternatives across credit and non-credit strategies, also from dollar one. The next 2 years, from 21 to 23, I was at Legacy Wealth Management, an independent RIA, helping provide its clients access to institutional private funds. And in April of 23, I decided to embark on my own with the C-suite support from Legacy, spinning out to create Divino Global Holdings, an investment management company and advisor, co-investing alongside families and institutions in capacity-constrained niche investment strategies across current income and total return. And that's what I've been focusing on since.
That's fantastic. And your background going from a more established legacy wealth firm and starting your own firm. I mean, that's a very entrepreneurial move, something that a lot of the cannabis entrepreneurs have done a similar path for. I'd love to get your thoughts on what it's been becoming an entrepreneur yourself and how you've enjoyed that ride.
It's been an incredible experience. Part of the reason I wanted to do it was at Legacy, they were focused on a specific path and within privates, primarily retail-focused strategies. I wanted the opportunity to incorporate my institutional experience into my investment portfolio and process, and have the flexibility to evaluate retail strategies when appropriate. And so I decided to set up Divino Global 2 years after spending time at Legacy, in large part because I realized at that point, if I didn't go the entrepreneurial route then, I probably would never pursue the opportunity. But
Mm-hmm.
since then, I've been able to explore and evaluate and source managers in what I call the under the radar category, managers that might have raised their fourth or fifth fund, but still, for whatever reason, haven't raised compelling plus $500 million type strategies despite compelling performance, as well as de novo funds that have proven concept in their pre-fund portfolios that I think have a defensible moat that will be sustainable for years to come. And since leaving Legacy, I've also executed management company stakes in two fund managers, one in specialty finance and another in digital health venture. And this has expanded our remit beyond traditional LP positions as well.
Wow, that's really interesting. And it's quite the contrarian strategy relative to other wealth managers who maybe just like to deploy into the big mega private equity funds, the Blackstones, the KKRs of the world, and not take a risk with some of these more emerging or underlooked managers. So I'd love to get your thoughts as to why you felt that finding those overlooked managers was really the better strategy for you.
Frankly, the experience I've had with emerging managers and under the radar firms has been overwhelmingly positive. In
Mm,
fact, we're an LP now in over 20 funds. I started co-investing personally alongside Catalina, as well as outside their mandate when I started shortly after I started at the firm in 2014. So over the past decade, we've committed to over 20 separate private funds, six of
Wow.
whom are co-investments alongside Catalina. Those are what I call my established manager bucket, effectively legacy private equity, because most of those vintages were executed in the 2016 to 19 timeframe. And that's where I got my buyout, secondary, and co-investment fund exposure. But outside of that, every commitment I've made in the fund category has been on the emerging side. Some of them have actually full cycled and have full cycled in compelling returns. And I've noticed those returns have typically outperformed most of my established portfolio. Now, there is some basis and tracking error because they're different sectors and different areas of focus. That being said, I think emerging managers continue to have the potential for outperformance, as well as uh, the issue that most large established managers face, which is having a tremendous amount of dry powder to deploy over a fixed period of time. They're not just competing with other large managers. Increasingly, I find them competing with strategics for acquisition targets, many of whom are chock full of capital, given the run-up in their stock price the last several years and their relative paucity of M&A in many of these sectors. And so because of that, I tend to focus on strategies that have less pressure to deploy and are more specialized in nature, meaning a relatively narrow sandbox within the sector they focus on, compared to the multi-sector mega managers that deploy capital across a variety of industries.
Very interesting. And is your investment focus entirely on alternatives, or do you also do public equities and credit as well?
My focus is primarily private alternatives. So
Hmm.
private credit actually happens to be the largest sector type across our portfolio. And within private credit, we also specialize within asset-based lending rather
Hmm.
than direct lending, in large part because I think direct lending is a very competitive and now commoditized space.
Sure.
I do invest in publics personally. Frankly, I do not think I have any particular edge in publics relative to the very talented managers already out there. And as a result, I tend to focus within my lane in privates where I've had demonstrated success and track record in investing in capacity constrained managers. And after specialty finance, private equity, real estate, and venture are our largest exposures in descending order.
That makes sense. And how do you think about liquidity over various parts of the economic cycle, right? Because that's one of the negatives that people often point to when it comes to alts, right? Is that you can become over allocated in a downturn and under allocated in an upturn. So I'm curious how you navigate that.
Sure. Liquidity is certainly a very important issue as we think about portfolio construction and sourcing new managers to add to our portfolio. A large part of our focus on private credit has been a meaningful portion of the total return is paid in current income rather than at the tail end, like we see in traditional private equity and many types of equity-focused real estate. And that's in large part how we achieve some type of focus on near-term liquidity by
Mhm.
generating a meaningful portion of our performance on a quarterly, semi-annual, or annual basis, depending on the frequency of payout of the underlying private credit strategy. And what we also try to focus on is uh, managers that have a demonstrated full cycle realization period
Mhm.
shorter than typical than most of their peers in the space. So, for example, part of the reason we committed to the digital health venture firm is they tend to be asset light, not capital intensive, and focusing on generating full cycle realizations within 3 to 5 years of investment. They demonstrated that in their first fund, a 2021 vintage fund, that as of the third quarter last year had already generated zero point 0.2 times DPI, which is
Mhm.
top quartile, if not top quintile for its cohort. What I've noticed is 2021 has been a very dry year, particularly in venture, in
Yeah.
generating liquidity for its investors. And so having sourced a manager like that who is determined to provide its investors with liquidity in a shorter time frame is something I value and prize. And that's why I decided to move forward on something, on a strategy in that particular sector with that particular manager.
That makes total sense. And as you think about your allocation across managers, do you do it from like a top down approach where you say, I want X% in credit versus real estate versus specialty finance? Or do you do it more bottoms up, kind of opportunistic? You find a manager you really like and then decide how much you want to allocate to them?
Initially, my portfolio construction, when I started investing in privates alongside Catalina, was top down because my own personal portfolio had no exposure to privates. And so I decided, within private equity, I want to get exposure to buyout, secondary, and co-investment to get a balanced profile of risk within the overall private equity sector. And within each of those particular segments, I created a list of quantitative and qualitative criteria to source the initial pipeline of managers,
Mm-hmm.
generated a short list, and then executed on the positions that our investment committee approved at Catalina. And then after receiving approval from the committee to co-invest in those funds that had capacity after Catalina got its full allocation, I started populating my own personal portfolio in private funds. Over the last several years, however, as my portfolio has matured and I've gotten a fairly broad representation across sectors, I've started instead now to go in a more bottoms-up approach, more
Mm-hmm.
opportunistic in its framework, more thematic in its strategy. And so, as an example, within healthcare, I'm not looking for a multi-sector manager who does life science, device, and health tech. Instead, I'm focusing on managers that have proven mousetraps within one or more of those sectors. The reason I decided to focus on digital health in particular was it's much less capital intensive and much more asset light than its life science counterparts and device counterparts. And as a result, the dispersion in return is far less binary relative to those particular sectors, which require 100x in a particular portfolio company to justify the continued R&D in that space. But with that 100x comes a lot of zeros.
Sure.
Having been a credit investor most of my career, even before starting in allocation, I prefer a much narrower return dispersion, doubles and triples in baseball parlance relative to strikeout and grand slams. And so as a result, now I'm focusing more on opportunistic strategies that are very narrow in sandbox and have managers that are able to execute in that sandbox, either in a previous fund at that company or in a pre-fund portfolio or in their previous life at a different firm.
Makes total sense. And as you find the managers that you want to invest alongside, how do you think about doing so via a primary fund commitment versus direct co-investment? And do you ever look at secondary fund investments of positions that have already been deployed?
We typically commit to primary funds. That being said, we have executed three secondary PE fund commitments alongside Catalina in the 2016 to 18 vintage cohorts. Two of them are what I call broad enterprise value managers, and one is a tail end focused fund.
Mm-hmm.
And given our bandwidth, I'm basically a team of one here,
Mm-hmm.
solopreneur. I admit I do not have the bandwidth to evaluate co-invests and directs on a systematic and programmatic way. And as a result, my funnel for funds is much sharper and more active than is my funnel for directs. That being said, over the past decade, we have committed to a handful of early stage companies, in large part because we have conviction in the CEO or the broader executive team in their execution of the strategy.
Makes total sense. And so then how about with regards to the cannabis industry? I know you've been interested and taking a close look over the years. I want to say we first met maybe 5 or 6 years ago when you were co-hosting a panel alongside one of my partners. So yeah, would love to just get your thoughts on your interest in the cannabis industry and how you've seen it develop over the years.
Yeah, sure. I still remember that panel quite clearly with your partner Tibby at Opal Newport. I believe it was
Mhm.
in the summer of 2021, July of 21,
That sounds right.
when we were looking at alternative medicine strategies effectively. Cannabis was one of the alternatives considered alongside, I believe, LSD, mushrooms, and the like. Part of the reason within all of those different types of opportunities, we focused primarily on cannabis was number one, there was an evolving framework, at least at the state level, being established. At the time, I think there were about at least 20 states that had at least medical cannabis cleared. And over the subsequent years, many more states approved medical and then recreational cannabis use. In contrast, many of the other alternative therapies did not have any such hope for a similar process to happen for them. And in addition, I think what really got me excited was at the end of the previous administration's tenure, the president had downgraded cannabis to, I believe, Schedule
Yeah, Schedule 3.
Schedule 3,
Mhm.
excuse me, and which was paving the way for everyone for the holy grail, effectively in the sector, which was to make cannabis federally legal, like it is already is in Canada. Uh, in addition, speaking of Canada, Canada provided a successful framework at the national level of having legalized cannabis a few years back,
Mhm.
already having publicly traded companies in the sector that were traded actively on their respective exchanges, and pretty robust regulatory and legal framework towards the plant. That being said, because there was a lack of federal approval and legislation in the US, I tended to focus on opportunities non-plant facing. And so initially, we looked at opportunities primarily on the real estate side
Mhm.
because we thought at the having being a credit guy looking at the downside, we thought that many of these properties, if cannabis went the other way for whatever reason, meaning moving into a more restrictive and cumbersome approach towards the space, many of these properties could be adaptively reused into other types of industrial applications. Because effectively these were warehouses that could be converted, for example, into manufacturing hubs or what have you. So we spent quite a bit of time with some managers in the space on the real estate side. And then we started exploring opportunities in credit
Mhm.
because since they were regulated at the state level, we felt if the lender was focused on a specific state or a set of states where it was recreationally legal, we thought there could be some traction there. I think only in the new administration have we really started taking seriously the opportunity for equity type plays. Your strategy in particular is one that we've shortlisted as a potential for further consideration, in large part because we think the current administration, to our positive surprise, is actually supportive of moving down the current path towards federal legalization. And the current president has effectively indicated as such, I believe at year end last year. And that type of guidance, I think, is certainly supportive of our moving forward in that approach. And that's why now we're looking at strategies in equity, not just real estate and credit within cannabis.
That makes total sense. Yeah, and I'd say that your sentiment around it being a surprise that the prior administration didn't move forward and this administration did very much resonates with the broader sentiments in the industry, right? And you definitely saw after the blue wave of the 2020 election that a whole bunch of money was invested in the cannabis space. Folks thought that federal legalization was going to happen like that. And then when it became clear that it wasn't going to happen under Biden, the capital markets environment just has completely dried up and made it very challenging for operators, especially newer ones who need new capital to raise. But all that said, now with the Trump administration moving forward with it, despite how much distress there's been, you also have great assets that have been underloved or overlevered, and so there's great opportunities on the buy side to really build something out of the ashes of the cannabis 1.0 industry.
Absolutely. And I think it's a great time to look at the space because you're still at the pre-inflection point. Because certainly the inflection point will occur once federal legalization happens. Until then, you're effectively looking at an asset class that remains, if not distressed, at the very least stressed in valuation in the U.S. And I think there is a lot of potential capital that could be allocated, but many people are still on the sidelines,
Yeah,
hoping for that legalization to occur. Once it does, I think that'll create a hockey stick framework for valuation. So it pays now to do your diligence and figure out who the players are that could survive in this new paradigm and separate the wheat from chaff as you develop a pipeline of potential investment.
totally. And so, as the markets contracted over the last few years, you saw terms get better and better, yet you've remained pragmatic and cautious about putting capital to work in the sector. So, I'm curious, like, what was it ultimately that caused you to say, still like the sector, but still don't think the timing's right over the last, call it 4 years or so?
Honestly, we've had a pipeline full of non kind of cannabis related opportunities
Mm-hmm.
with opportunistic themes.
Mm-hmm.
I mentioned the digital health venture firm. I mentioned the specialty finance fund, which was our first management company stake. That presaged a whole host of capital that was invested in the government contracting space. This specialty finance lender focuses on lending to mission critical government contractors. We're currently looking at an aggregator of parking garages across the US. We've only identified one other player who's doing that. One other credible player, let me rephrase, who's doing that, and they focus only on New York. So, there's been a plethora of thematic opportunities that we are looking at the moment
Mm-hmm.
that have basically taken priority over an exclusive focus on cannabis. It doesn't
Mm-hmm.
necessarily mean that we think it's not an opportune time for considering cannabis further. It's just a question of bandwidth and prioritization, quite frankly.
Totally. That makes sense. And you touched on it in that last question, but I'm curious if you have any other emerging sectors that you think are interesting and you're doing more of like a holistic analysis of at this point.
For lack of a better term, I would call it specialty real assets. Okay. Uh, uh, is the sector where we're spending the most time. One is a gas station aggregator who
Hmm.
is combining with an operating company to create an owner-operator framework to source independently owned gas stations across the country. One piece of legislation that wasn't aware of was the significant tax advantage of his investing in the space from the OB3 Act last year, One Big Beautiful Bill Act.
Hmm.
100% depreciation can be taken as a deduction in year one on the non-land portion of the gas stations, which
Hmm.
makes it tremendously attractive for high net worth and family offices that have significant gains to offset those gains in this type of strategy and get potentially greater deductions than they would with a 1031 exchange or other alternatives.
Mm.
So that's another play. We're also looking at specific regionally focused specialists within industrial and office in the Southeast in particular, where we think there's been an under supply, under investment in the category over the past few years. And then we also continue to look at specialty finance plays,
Mhm.
managers that have proven mousetraps within their respective niches and are generating perhaps maybe not full equity type returns, but more mezzanine slash equity like return profiles with much lower levels of risk, typically sub 3 year duration, senior secured, mostly unlevered type strategies.
Fantastic. And with regards to the cannabis industry, you mentioned that rescheduling will definitely be a big landmark, which we fully agree with in terms of attracting new institutional capital to the sector. How do you envision, assuming that that continues to go through, how do you envision larger pockets of capital and institutions coming into the cannabis space? Do you think rescheduling will be enough, or do you think that a lot of those folks will still need further legislation, such as the safe banking, to really get involved in a big way?
I think safe banking is one of the critical steps needed, Jordan. And the reason for that is, at least my understanding within cannabis in the US, is uh, most transactions are still done through cash.
Mhm.
And it's very challenging to scale a business if you're operating with primarily cash transactions. Safe banking, in contrast, as far as I understand it, will allow federal banks to underwrite cannabis operations and to provide loans to cannabis businesses and allow customers to buy a product on credit card or debit card rather than cash. And I think that would be a landmark event, a seminal event, in fact, to drive growth within the sector. I would, of the two, I would hope that safe banking comes uh, at the very least concurrent with full legalization, ideally before full legalization, so that at least at the state level, the states that have it recreationally legal can allow that, then can allow those types of electronic transactions to occur, so that when full legalization happens, it'll just be applying that patchwork of statewide laws to the federal level.
Totally. That makes sense. Well, Adi, this has been such a fun conversation. I really appreciate you joining the podcast this afternoon.
Thanks very much, Jordan. It was a pleasure speaking with you. I really enjoyed sharing my perspective, and I appreciate the opportunity to catch up with you and share my viewpoints on the industry.
Absolutely. And if folks that are listening want to learn more about you or Divino Global, potentially become a client, is there somewhere that they can find more about you?
Sure. I have my LinkedIn profile, Adi Divgi, Divgi is the last name, and I'm in the process of creating a website, adidivgi.com, and separately divinoglobal.com. But I need compliance approval for each. So until those are finalized, until that's given, I can't necessarily launch those formally.
Gotcha. Well, we'll keep an eye out for that. We'll make sure to tag you on LinkedIn and in the show notes. And thanks again for joining the show.
I appreciate it. Thanks, Jordan.
Yep. Have a great one.
You too.